A $53 billion buyout offer is on the table, yet PayPal insists its standalone turnaround is worth even more. But does this private equity bid represent a desperate bailout, or is the crowd mispricing the firm's true fundamental value? Total payment volume surged 11% year over year, reaching a massive $464 billion. On the surface, the business looks incredibly healthy, smoothly processing everything from your weekend Venmo splits to massive enterprise checkout flows. Pundits are screaming about how total revenue also climbed 7% to hit $8.35 billion. At first glance, the consensus assumes this top-line acceleration means the core ecosystem is firing on all cylinders. But when you dig into transaction margin dollars, which grew by a meager 3%, you realize PayPal is effectively buying volume at the expense of profitability. This disconnect reveals a deep structural headwind. Management is spending heavily on strategic investments just to maintain market share against agile competitors. This brings us to the real elephant in the room regarding operational efficiency, where the transaction margin plummeted by 208 basis points to 45.6%. Most analysts are purely focused on user acquisition, but this severe contraction exposes a very real ceiling in pricing power. The company is facing rising operational costs to keep merchants locked into its unseen digital infrastructure. Until this specific transaction margin stabilizes, institutional investors will remain highly skeptical of the core business model's long-term operating leverage. To fully grasp why this profitability squeeze is happening, we need to look at consumer engagement. Active accounts crawled up by a mere 1%, leaving the firm with 439 million active users worldwide. The public is captivated by digital wallet adoption, but the fundamental reality is the platform is nearing peak market saturation. Further compounding this structural issue, the trailing 12-month transactions per active account actually declined by 1%. This drop in transactions per active account indicates that future revenue generation must rely entirely on increasing the monetization of existing users. The business must pivot urgently, deepening its consumer financial services through integrated banking features rather than chasing new sign-ups. But even with these operational challenges, there is a powerful defensive mechanism at play that changes the entire valuation debate. Adjusted free cash flow surged an impressive 25% year over year, delivering a massive $1.72 billion financial cushion. This robust adjusted free cash flow acts as a vital shield against ongoing market volatility, providing PayPal with the financial ammunition needed to fund restructuring. This underlying cash engine proves legacy tech platforms are not entirely vulnerable. It allows the firm to navigate global uncertainty without relying on expensive external debt or dilutive equity offerings. In a clear bid to appease frustrated investors and defend against institutional pressure, management heavily leveraged this liquidity position. The company deployed a staggering $1.5 billion directly towards share repurchases during the quarter. Adding to this aggressive capital allocation strategy, the board also initiated $130 million in newly declared dividends. By systematically shrinking the weighted average share count by 8% over the trailing 12 months, the business is artificially supporting its per-share metrics. This capital return strategy is a critical pillar in convincing institutional holders that remaining independent is the superior path. However, we must address the internal product conflict quietly dragging on these precise valuation metrics. The unbranded payment service provider segment, which handles invisible back-end enterprise processing for large merchants, posted a mid-teens % growth rate. At first glance, you might think this unbranded payment service provider growth is a pure victory for the firm. The fundamental reality is that this specific volume powerhouse carries significantly lower margins than the traditional branded consumer checkout experience. This creates a severe strategic bind where the fastest growing segment of the business is simultaneously the biggest anchor on its profitability profile. To counteract this relentless margin pressure, management is aggressively altering their operational playbook. The board is betting heavily on an enterprise-wide automation transformation, promising at least $1.5 billion in gross run rate savings. These targeted gross run rate savings are a mandatory operational requirement to optimize cost structures. If executed correctly, this efficiency drive could be the exact mechanism that reverses the current margin compression. Once you grasp this, you will look at financial reports differently, recognizing that cost controls often dictate survival more than hype. Yet despite this highly ambitious roadmap, management's full-year non-GAAP earnings per share guidance points to a potential low single-digit drop. This lackluster non-GAAP earnings per share guidance directly undermines the argument that the company is on the precipice of an immediate, flawless turnaround. While domestic challenges dominate the headlines, we also have to evaluate the resilience of the global footprint. International total payment volume grew by a stable 2% on a currency-neutral basis. The public often overlooks overseas performance, but this international total payment volume proves the firm maintains critical infrastructure access across diverse regulatory environments. PayPal officially joined the European Payments Council, a strategic move ensuring its digital wallets remain deeply embedded in cross-border commerce. By integrating seamless digital transactions into mobile experiences, the company is actively fighting to retain its merchant relationships. But the threat of well-capitalized banking institutions launching rival platforms keeps the pressure extremely high. Investors are now forced into a high-stakes psychological waiting game. The non-GAAP operating margin came in at 18.4%, representing a notable deterioration from previous highs. When analysts see a non-GAAP operating margin contracting like this, the immediate reflex is to assume the competitive moat is permanently impaired. But this is where the real structural advantage lies, because the sheer scale of the network cannot be easily replicated. Management knows that the 439 million global active accounts represent an irreplaceable asset, even if the monetization engine is sputtering. The fundamental truth is that the ongoing restructuring effort is entirely about ruthless operational discipline. This brings us back to our main thesis and that massive private equity proposition. The $53 billion buyout offer from Stripe and Advent International serves as a stark valuation floor for PayPal. While the board rejected the offer as inadequate, the unsolicited bid highlights a massive disconnect between public market pricing and private institutional appraisal. This forces the market to critically evaluate if management's operational overhaul can actually deliver. The company is operating under a strict strategic ultimatum, meaning every single quarterly report going forward will face unprecedented scrutiny from institutional holders. The sheer magnitude of this situation proves that the stakes have never been higher. Ultimately, the massive 11% volume growth is becoming structurally uncoupled from profitability, forcing a necessary pivot from top-line expansion to absolute margin defense. The board's rejection of the buyout means they must flawlessly execute their forward guidance. For the patient investor, the current valuation presents a complex scenario. With aggressive share buybacks, strong cash generation, and a clear floor set by private equity, this is not a traditional value trap. Instead, the firm is a powerful compounding machine currently undergoing heavy maintenance, requiring careful observation before deploying fresh capital. If they can bridge the gap between their top-line expansion and underlying operational efficiency, the long-term upside remains incredibly compelling today. Do you believe the internal turnaround will ultimately surpass the $53 billion buyout offer, or is the board making a massive mistake by rejecting private equity? Let me know your thoughts on this down in the comments. So hit subscribe so you won't miss what's next, and jump straight to the next video, because that could be the very insight you need to get ahead.